Hello, in this video, we will talk about the finance module. Since we've completed the decisions related to R&D, marketing, production, and sales, now it's time for us to make financial decisions. Here in the finance module, it is not going to be individual product segments. This is a collective decision-making about all the products together. If you remember, within the production section, we automated plants, we sold plants, we bought capacity, and so forth. So here, we need to finance those. The fundamental rule in finance is anytime you're making capital expenditure, you want to ensure that it is covered by either debt or equity financing. So capital investments should be funded by, unless you have surplus of cash sitting around, you should always borrow it from the market. You should not rely on your cash, operational cash to actually fund such investments. So when you actually look here, we have made a total investment of $34 million while we actually sold, capacity or equipment worth $6.6 million here. So the difference is what we need to borrow, or we need to, sell some stock to actually make up for that money. So the beginning of the year, what you actually have is $3.4 million. Okay. In addition to that, what's happening is you're depleting some of your existing cash, even making after $10 million fine, profits, as we actually saw in your pro forma income statement. This is the end cash position. This is not good. So how do we tackle with this? So there are two options to deal with this. So first, let's look at how much our total expenditure is going to be. So that's going to be $34 million. That's 34 million. As you know, these are all represented in thousands, the last three zeros. So it's 6695 is what you're actually getting out of 6695, equipment. So net capital investment is the difference between the two. So you actually have this minus this. So that's $27.3 million is what you need to raise from the market. As you remember, you had about $32 million that you could actually raise. So here, what are the options? The first one is long-term. Always use long-term debt in order to fund your capital expenditure. Short-term or current debt is only to fill the operational or deficit that you may actually have. You may be tempted to actually use current debt because of the lower interest rate compared to your long-term debt. But the problem is this amount will be required to be paid off, whatever you borrow here, on the very first day of next year's operations, which is going to be problematic because if you don't have surplus of cash, you have to borrow again. So this will cause a problem in terms of your ability to invest your money into different stages, different operations each round, if you continue to rely on current debt. What I would say is issue long-term debt. If you have surplus of cash, you can always repay. And if you really don't need, or you can buy back stock, you can do all of these things as required. Now, your current starting price of per share is 34.25. Okay, so your maximum ability to issue is about 13.7. So the benefit of using equity is that you are not having to pay interest, or you do not actually have to pay it back. Okay, so for long-term debt, the downside of it is that it is going to be interested, it comes at a cost that adds to the cost of operations. You have to pay interest, right? That takes away from your net profit. And the other thing that is also going to happen is you have to repay it over a short period of time, but these are, small payments that are coming due later in our round 3, round 4, because it happens about over a long period of time. You don't have to pay everything back immediately. So that's the benefit, but the cost is going to be that you have to pay interest. The downside of using shares or issuing stock is that your EPS will go down because you have more outstanding stock for the amount of profit that you're bringing in. Also, what happens is that dents your stock price because there's more outstanding stock. The profits are going to be distributed over more number of people. The ownership is going to be distributed over more number of people. So therefore, the appreciation of your stock is going to be less. For example, for somebody that is at 34.25, did not issue any stock, issued all long-term debt. For them, the profit, net profit, what are you making, is going to be distributed over fewer owners. Okay, so therefore, the stock price will appreciate more for the same amount of net profit. If you issue all equity, all debt, what's going to happen is that your interest expense will be high, and therefore, what's going to happen is your net profit is going to be declining anyways. So there's more of a balancing act here. What is the best course forward? So let me see what's available to you. You also have to look at that. 13.7 is what is available in stock. Okay. Okay. Long-term debt that is available to you is 18.994. Okay, this is what's available. So let's look at total. So that's about 32 is what you actually have. So you have, you spend 5 million less than what's available to you. So what I would generally suggest is take a balancing act and issue half in stock, okay, and half in debt. Again, this depends on what your ultimate goal is. So if your professor is using more of what you call balanced scorecards, this is the best approach to go forward, and also will help you maintain leverage and things like those. So that is what I would use. So see, it's pretty close to maximum stock issue and 18,994. So this is what I will actually do is, how much is this? 13,652. So I could issue all of this. Okay, and here. Okay, so this will inflate your cash position and show you here, this is only contingent upon all your numbers being right in terms of the number of amount of sales that you said, amount of profit, not holding back any inventory and so forth. So you got to be careful about that. In terms of, this is, I would say, is not an accurate figure. Could be, could not be, because you're making an assumption that, if you're thinking that this will be your final cash position at the end of the year, you're basically thinking that all your numbers are right. You exactly predicted how much you're going to sell, produced, and everything was sold. That's usually not what happens. Usually what happens is your predictions are wrong, you're off. So you don't want to get in a tricky situation. If you have surplus cash, you could actually use it next round for not fund your operations, but your capital expenditure to some degree, or issue dividends or pay back stock, buy back stock, and so forth. Now, let's look at in case if you spend $40 million, okay, you don't have, because the 32 is the maximum that you actually have this round. So you could actually borrow some of them here. All you have to do is, add some value here, whatever you're actually falling deficit in, okay, to fill the gap. So that's how you can actually get. So basically, this amount that is available to you is bankers will loan current debt upon 75% of your accounts receivable and 50% of your inventory, okay? So if you don't have any inventory left, bankers cannot issue on that. And whatever your accounts receivable is, which is based on AR and AP, that's what it is. Okay, assume the worst case companies will have 3 to 4 months of inventory and they will loan up to 50% of that amount. So basically, this is only a stopgap measure and really not a sound decision unless you're falling short on cash. So Capital expenditure, always long-term debt or issue stock. Okay, and also here you're able to adjust your accounts receivable and accounts payable. Accounts receivable is the number of days your buyers have to actually pay back. If you actually increase this number, this is more favorable terms to your buyers. So therefore, they're going to be more demand for your particular product. This is when industry gets more competitive and you want to figure out more ways of selling more product of yours. So this is one way to differentiate and start selling more product. Accounts payable. If you actually reduce this, your product becomes less attractive. This is mostly to manage your cash position end of the year. That's how you actually do. Accounts payable is this is the terms that you're offering to your suppliers. Okay, the shorter the duration, the better it is for the suppliers. The longer the duration, the vendors will hold parts and they may not want to sell it to you. This might cause little problem in your operations. So this is your finance module. And when you're actually done with this, I would always go back and look at your cash flow statement. Okay, see what your end cash flow position is. So if you actually see here, your net income or losses are this. Okay, this was about $10 million, if you remember previously. This has declined. Why? Because of the interest expense that was added because of the debt that you actually borrowed. Okay, so this is your depreciation write-off and change in inventory position, change in accounts receivable and so forth. So this is improvement. So this is how much you're making from your operations, but however, this is the amount of money that you're actually putting in. And this is the money that you're raising from stock. This is the money that you're actually raising from debt. Okay, overall, this is the balanced position. End of the year, you should be ending up pretty close to this if your numbers are right. If you're wrong, this will be lower. But still, if this goes to zero, what happens is you're issued a what do you call as emergency loan. You never want to be in that particular situation because that creates a lot of bottlenecks for your future rounds of decisions. So it's always good to make plans for your operations ahead of time and borrow when the money is actually available. If you actually get into debt, not debt, but into your a situation where you run out of cash and your emergency loan has triggered, which is a loan shark. Okay, so they take steep interest and it has to be paid on the very first day of next day's operations. You have to sell, plant, equipment, or you have to do a lot of things that are going to be stagnating your ability to invest into capital infrastructure that's going to give you a competitive advantage. Hence, always when the money is available, borrow, fund, and issue stock to actually make sure that your operations or your capital expenditure is fully funded. So with that, I'll conclude this particular video. These contexts change. Please note that these contexts change as you progress further in rounds when you don't have any much of capital expenditure and you have a lot of cash sitting around. So you can always pay back your debt, or you can use that to fund your capital expenditure, whichever is suitable at that point of time. This kind of decision making is useful in the first 3 rounds. I hope this video helped you learn about the finance module and how to actually make decisions on that matter. Good luck.